Hey there! So you've probably heard about recessions. Maybe you're even secretly afraid of them, right? Well, don't worry, you're not alone. The truth is, recessions can be a little like that bad weather forecast. You're not sure if it'll rain, but you definitely want an umbrella, just in case. And just like you wouldn't leave the house without an umbrella, you shouldn't go into a recession without a solid plan to protect your investments. Today, we're going to talk about how to shield your wealth during tough economic times. No need to panic or hide under the covers. Let's make sure your investments stay safe and sound. Ready? Let's dive in. Recessions can be like a wild roller coaster ride. 1 minute, things are looking good, and the next, whoosh, down you go. But here's the thing. It's not about avoiding the ride altogether, it's about knowing how to strap in and survive it. And that's where risk management comes in. You see, investing isn't just about finding the next big winner. It's about protecting what you already have, especially when times get tough. During a recession, the market can be more unpredictable, but that doesn't mean you should throw in the towel and sell everything. Instead, we're going to talk about smart strategies to help you keep your investments safe, even when the economy is in a tailspin. But hey, I want to know, what do you think about recessions? Have you ever had to adjust your investment strategy during one? Drop a comment below, I'd love to hear your thoughts. Okay, let's get to it. Grab your umbrella, and let's take a deep dive into the world of risk management. Alright, before we jump into strategies, let's quickly talk about what a recession actually is. Now, I know it sounds like a big, scary word, like tax audit or flat tire. But trust me, it's simpler than it sounds. A recession is essentially a period when the economy starts shrinking instead of growing. We usually see things like reduced consumer spending, fewer job opportunities, and a drop in the production of goods and services. It's like the economy takes a little nap, and businesses just aren't as busy as usual. Now, why does this matter for investors? Well, during a recession, stock prices can drop, interest rates can rise, and it can feel like everyone's holding onto their wallets a little tighter. For investors, that means some of your favorite companies might not be performing as well as they were before. Suddenly, that high-flying tech stock might not seem like such a great deal anymore. And if you're heavily invested in those high-risk areas, well, let's just say it could lead to some sleepless nights. But not all hope is lost. Recessions can actually create opportunities too. If you're smart about it, you can navigate through these rough patches with a solid plan. I'd love to hear, have you noticed any changes in the market when a recession hits? Drop a comment below and let me know. Let's talk about risk management in investing. Now, before you roll your eyes thinking it sounds like some boring finance term, trust me, it's not. Think of it like taking care of a plant. If you just throw it in a corner and forget about it, it's probably not going to thrive, right? Risk management is about making sure your investments are well watered, well lit, and protected from any pests. Basically, setting up a good environment for your money to grow, even when the economic weather isn't perfect. Now, in the world of investing, things can get a little crazy. Markets go up, markets go down, and sometimes they just decide to take a nap for a while. That's where risk management comes in. It's your shield against unexpected market storms. Risk management helps you avoid big losses by making sure your portfolio is diversified, meaning you're not putting all your eggs in one basket. And it also means knowing your risk tolerance, or how much you're willing to lose without breaking into a cold sweat. It's also about staying calm when things get shaky. I mean, have you ever seen someone panic during a market downturn? Not a pretty sight. But with a solid risk management plan, you can handle these bumps in the road a lot better. Speaking of which, what's your strategy when the market gets volatile? Let me know in the comments. I'd love to hear how you handle it. Welcome back. Alright, we've already talked about what a recession is and why it matters. But now, let's dive into the good stuff. How to protect your investments during tough economic times. Think of it as a battle plan, but instead of swords, we're using smart strategies to defend our wealth. Markets during a recession can feel a little like a battlefield. But don't worry, there are a few key strategies that can help you win the war and come out on top. Ready? Let's break it down. First up, diversification. Think of it like making sure your lunch doesn't just have one type of sandwich. You need a variety to balance out the flavors. In investing, it means spreading your money across different asset classes, stocks, bonds, real estate, maybe even a little cash on the side. Imagine if you invested everything in tech stocks. Sounds good when the market's booming, right? But when a recession hits, those stocks can take a nosedive, and suddenly you're left with a lot of disappointment. Instead, by diversifying your investments, you're less likely to feel the full brunt of a market downturn. For example, if your stocks take a hit, your bonds or cash reserves could help balance things out. It's like having a cushion to land on when the economy does a little freefall. Now let me ask you, how diversified is your portfolio? Have you found the right balance between riskier assets and more stable ones? Let me know in the comments. Next, let's talk about asset allocation. Think of asset allocation as the way you divvy up your pie. The goal is to match your investments with your risk tolerance and your time horizon. During a recession, it's smart to lean more towards safer assets like government bonds, precious metals, or even cash. These tend to hold their value better when things get bumpy. So, if your portfolio is mostly in stocks, it might be time to shift a bit into lower risk assets. Think of it like wearing a helmet when you're riding a bike. Extra protection never hurts. Now, if you're young and still have time to ride out the economic waves, you might keep more in stocks. But if you're nearing retirement or just don't want to take as many risks, it's time to consider rebalancing your portfolio. Have you made any adjustments to your portfolio lately? Do you think you should? Drop a comment below and let's see what everyone's doing. Now, let's talk about defensive stocks. No, these aren't the stocks you pick if you're trying to build a football team, but they are the ones that can keep your portfolio strong during a recession. These are companies in sectors that tend to perform well, even when the economy isn't doing great. Sectors like utilities, healthcare, and consumer staples, think things like electricity, water, toothpaste, and groceries, are great choices during a downturn. Why? Because people still need these things no matter what's happening with the economy. It's like investing in the essentials, things that people just can't live without. Can't skip out on toothpaste, right? These defensive stocks help provide some stability in your portfolio when other sectors may be struggling. So, do you have any defensive stocks in your portfolio? Maybe some utility companies or healthcare stocks? Let me know what you're into in the comments. Hedging. Now, this one might sound like a fancy term, but it's actually a clever way to protect your investments. Think of hedging like carrying an umbrella in case it rains. It's a strategy to limit losses by making investments that go up when other investments go down. Common hedging strategies include buying options or investing in inverse ETFs. These tools can act like a buffer for your portfolio. When markets fall, these investments might rise, helping you offset potential losses. Hedging isn't for everyone, it's a bit more advanced, but it can be a powerful way to protect your wealth, especially during periods of high uncertainty. Do any of you use hedging strategies? I'm curious to hear your thoughts in the comments. Let's not forget about the emergency fund. We've all heard the rule, save 3 to 6 months of living expenses for emergencies. But during a recession, this becomes even more important. Having an emergency fund means you won't be forced to sell your investments during a market downturn. Think of your emergency fund like a safety net. If the market takes a dive and you need cash, you can dip into your emergency savings instead of selling your stocks at a loss. This is one of the best ways to avoid making panic-driven decisions that could hurt your long-term financial goals. Do you have an emergency fund in place? If so, how much do you think is enough? Let's hear your thoughts in the comments. Alright, last but not least, staying calm. We've all seen those market crashes where panic sets in, and everyone starts selling off their investments in a frenzy. But this is where emotional control becomes key. Instead of reacting emotionally, it's important to stick to your plan. If you've already done your homework, diversified, and protected your investments with the strategies we've discussed, then you don't need to make any rash decisions. Sometimes, the best thing you can do during a recession is just, well, nothing. Keep your focus on your long-term goals and don't let short-term volatility derail your strategy. So, how do you stay calm when the markets start to freak out? I'd love to hear your tips for managing stress and staying focused. And there you have it, your strategy guide to surviving a recession without losing your cool. Keep these key strategies in mind, and you'll be in a much better position to protect your wealth during tough times. Let's talk about one of the most important things you can have in your financial toolkit: emergency savings. You've heard of it before, right? That little stash of cash tucked away for a rainy day? Well, during a recession, it's not just a nice to have, it's a must-have. Think of your emergency savings like your umbrella. You don't always need it, but when a storm hits, you'll be really glad you have it. During a recession, your investments might not perform as well as usual. That's where your emergency savings come in, keeping you financially stable and preventing you from having to sell your investments at a loss just to cover expenses. Having cash reserves means you don't have to panic and liquidate your stocks or bonds when things go south. It's like having a cushion when the market gets bumpy. Instead, you can keep your long-term investments intact while using your savings for day-to-day expenses. Now, I know the idea of saving money for an emergency fund can sound a little boring, but trust me, when life throws you a curveball, it'll feel pretty good knowing you've got a safety net. What's your take on emergency savings? How much do you keep aside for unexpected situations? Drop a comment and let's compare notes. Alright, let's dive into something that doesn't always get talked about: your mindset during a recession. It's easy to focus on the numbers, the stocks, the bonds, but what about the mental side of things? Believe me, your psychology can make or break your investment strategy during tough times. Investing during a recession is like riding a roller coaster. At first, everything's smooth, but then, whoosh, you're dropping fast. When that happens, the key is staying calm and sticking to your strategy. Look, I get it. Watching your portfolio lose value can feel like trying to hold onto a stress ball that keeps slipping out of your hands. The urge to sell everything and just get out is strong. But that emotional decision can often make things worse. Here's the thing: panicking can lead to poor choices. If you sell your investments when the market is down, you're locking in those losses. You've got to fight the urge to react emotionally. Trust me, your future self will thank you. Emotions are powerful during a recession, but if you can focus on your long-term goals and ignore the short-term noise, you'll be much better off. So how do you handle the psychological pressure when things get tough in the market? I'd love to hear how you stay calm. Drop a comment below and share your strategies. We've covered a lot today, from understanding a recession to strategies that help protect your wealth. And while we can't control when a recession happens, we can control how we prepare for it. And that's what separates successful investors from the rest. Remember, it's not about avoiding risk altogether, it's about managing it. Diversifying your investments, adjusting your asset allocation, and keeping some defensive stocks in your portfolio can help you weather the storm. Plus, having a solid emergency fund means you won't have to sell off your investments at the worst possible time. And of course, don't forget about your mindset. During a recession, it's easy to let panic take over, but staying calm and sticking to your long-term plan is crucial. A clear head can often make all the difference in your investment journey. When things get bumpy, it's not the time to make emotional decisions. Focus on your goals, and remember that recessions are part of the cycle. The market has always bounced back, and it will again. So what's your strategy when it comes to preparing for a recession? Are you focusing more on cash reserves or maybe diversifying into defensive stocks? Drop a comment below. I'm really curious to hear what's working for you. So, we've talked about how to protect your wealth during a recession. Let's quickly recap the key takeaways, like a financial cheat sheet, but with more strategy and less caffeine. First, diversify your investments. Don't put all your eggs in one basket. Mix it up with stocks, bonds, and maybe even some cash. This way, when the market dips, your portfolio doesn't take the full hit. Second, adjust your asset allocation based on your goals and risk tolerance. If you're near retirement, it might be time to lean more on safer, steady investments. Don't forget about your emergency fund. That rainy day stash will keep you from panicking and selling your investments when the market shakes. Finally, stay calm and avoid emotional decisions. Recessions are temporary, and if you've got a good plan in place, you'll come out stronger on the other side. Well, there you have it. You're now armed with the knowledge to protect your wealth during a recession. Remember, risk management is key, and with the right strategies, you can weather any storm. But hey, don't just stop here. Your financial journey is just getting started. If you found this video helpful, or even if you just enjoyed hearing me talk about recessions, make sure to drop a comment below and let us know your favorite risk management tip. We love hearing your thoughts. Don't forget to hit that subscribe button so you don't miss out on any of our future videos. Trust me, you'll want to stay updated as we keep tackling the big topics in personal finance. And hey, share this video with your friends. They'll thank you later when they've got a better financial game plan. By the way, if you're looking for more tips on building wealth or staying financially fit, check out the video right here on screen. It's packed with even more valuable insights to help you crush your investing goals. Stay smart, stay calm, and keep investing like a pro. See you in the next video.